Welcome to the Beulah Capital Quarterly Update. I'm Tom Elliott, Director of Beulah Capital. With me is Christian Ryan, our CEO. Now, let's just quickly have a look at the quarter just been. So, the mining sector's had a particularly good run. Now, last year we had both buybacks and special dividends, and since then the share prices of BHP, Rio and Fortescue have all been buoyed by high iron ore prices. This, sadly, is a result of a tragedy in Brazil. A tailings dam collapsed, and that's affected production by their biggest competitor, Vale, but it is good news for Australian shareholders of those companies. We're into the second week of earnings season at the moment. Overall earnings are pretty flat. Having said that, the market's been reasonably strong lately, although that's been more driven by overseas factors since the strong US stock market. The banks got, well, people thought they would be hit hard by the Royal Commission. In fact, they weren't. In fact, the Royal Commission went so easy on the banks, I was very surprised. The bank share prices have rallied quite considerably. The same can't be said for mortgage brokers, like Mortgage Choice, for example, fell 25% on the day that the Royal Commission's findings were handed down. And that's because the Commission is essentially recommending that trail commissions to mortgage brokers be scrapped. And that's a fundamental change to the industry. It's not very clear how mortgage brokers, if that recommendation is followed, will continue their businesses. Telstra had a pretty poor earnings result. It admitted that it's not making any money from selling NBN contracts. It says the NBN is too expensive. It's got a big hole from former fixed line earnings to fill, and it's not entirely clear how it will fill that hole. Fund managers like Magellan had a spectacular interim result, and Magellan shares have risen quite strongly in recent times. However, it is a fund manager. Money goes into fund managers, and money can go out of fund managers. Anyway, as to what we can expect in the near term, I'll hand it over to you, Christian.
Yeah, thanks, Tom. Look, after a very difficult 2018 for investors, 2019, I suppose in January, has actually started on a positive note, certainly for returns coming back to investors. Through February, as reporting season kicks off, it's probably showing that markets can be and will be for 2019 quite a volatile period. It's a period where we think at the moment, from an investment point of view, that it's sort of a late stage of a business cycle, investment cycle. Fortunately, I think for investors, what we thought last year where interest rates might keep rising, there seems to be a pause across the world that, hang on a second, we might have put the interest rate rise happening a little bit quickly. So this year looks like, at this point, that interest rates might hold a little bit more sensibly to allow to see how growth comes. On top of that, one of the areas that I think for investors we need to be looking at is assets that we can position in the portfolio that just, I suppose, have less risk or less reliance on day-to-day market volatility. The last review or quarterly update, we started looking at some of those types of investments, so particularly if you can hold investments in debt, particularly in while banks and all these types of large institutions are pulling out of these areas, there are a number of investors or firms deciding to step into the fold and provide attractive returns to investors. The last one, I think, for us, looking for 2019, it's going to be still a very challenging year. Overall, I think the biggest risk that we see for 2019 is one where the trade war actually sorts itself out at some point. It does seem, certainly Trump has gone a little quieter on the tweaking front. And secondly, I suppose across the world is policy and whether they do move too early on interest rates and also some of their, I suppose, policies that they make around the world, how much effect that will have on the market. So for us, for 2019, we're seeing it as it's going to be a pretty challenging year. We're going to have to remain pretty diligent and active across all assets to make sure that, one, we can still get a suitable return for investors.
And one more thing to look out for, not necessarily look forward to, is of course the upcoming federal election. It can be held as late as May, however the government could go early, particularly if it loses a vote on the floor. Look, the polls are narrow, but they're still suggesting that the Labor Party will win, and that's got big implications for investors. It means the end of negative gearing on established properties. Labor has been very, very clear about that, so you'll only be able to negative gear new houses, not existing houses. Secondly, of course, if you're a self-funded retiree, drawing a pension from your own super fund and you're invested in dividend-paying and franking credit-bearing companies, you're going to have your incomes cut. And again, the Labor Party is making no bones about that. A lot of pensioner groups getting very upset, but I don't think the party's going to change. Anyway, thanks very much for listening, and we'll talk to you again very soon.